Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates and 10-year note yields kind of spinning their tires today, even though we had FOMC, even though we had some data this morning, and even though there's a lot of risk rising globally. Yes, probably talking about the issues going on in Iran. We're looking at areas, potentially in the U.S. domestically, economically, and, all over Europe, there's still some financial issues going on, but the market just seems to be not being able to make one move, commit higher yields or lower yields. And today we got as high as 299. We were unable to breach the 3% level, and then we backed off. And right now we're sitting around the midpoint of this week at around 296. And I think that that's kind of where we'll stay unless we get some kind of a jolt. It's not going to come from the domestic economic numbers we get on Thursday. It'll likely come either from non-farm payroll or perhaps something out of the Middle East. So right now the market just kind of waiting. We need to move north of 3% to see any kind of extension. Likewise, we need to see them trade back towards 280. We're really, we failed the 3% today, but maybe we have another shot with a strong jobs number. But that being said, we're kind of in the midpoint, just kind of hovering. And market volatility in rate space has been underwhelmed. It's underwhelming. We see us, we got to some higher levels a few weeks ago. We've just been kind of drifting lower. The market seems very comfortable in this 290 to 3% range. Recall going back a few months, we were looking at 275 to 285, 280 to 290, and 290 to 3%. And then we got above 3%. It looked like we were going to make a breakout move, and alas, we didn't. And market volatility has really just been sinking ever since then, despite the fact that we have big news coming out later this week, despite the fact that there is a potential for the Iran nuke deal to come off the table, and despite the fact that there's still issues going on in Europe politically. So I think right now market volatility is very cheap and very low, and it has been for a long time. But now it could be, there could be some buildup of slack that maybe the market hasn't seen in a while. And lastly, let's talk about FOMC. May FOMC meeting today. Again, an underwhelming, announcement come from the statement. Yes, they talked about, inflation, hitting their 2%. Yes, they talked about some of the growth aspects of the economy. But the sense I get from the statement today is that the Fed will continue to raise rates gradually and cautiously, meaning that I think that as we go forward, they may not look to put their foot on the gas and raise rates more quickly. In fact, they may look to do exactly the opposite, which may be to back off a little bit. And right now we're looking at Fed funds pricing in, yes, a rate hike in June, and yes, another by the end of the year. But that fourth elusive rate hike is nowhere to be seen. And I think that if we look even further out in 2019, things get even more unclear, despite the fact that the forward projections tell us that they want 3 rate hikes in 19 and 3 rate hikes in 20 and however many after that. Right now, that seems to be a bit of a pipe dream. And essentially, we have to keep our eye on the ball, which is really June FOMC, where it is a slam dunk price by the market. But ultimately, as the data comes through, the rate hike will come, and then what happens after June could be, a lot of uncertainty there, whether or not the Fed, is able to continue their gradual rate hikes or even add a fourth, possibly at the September meeting. So right now that's not on the board. But so ultimately, 10-year notes finding a little bit of a home in that 290 to 3% range. Volatility is low. We still have non-farm payrolls coming up later this week. Also, a lot of data on Thursday, and we have to keep our eye on the tape because trade war talks and Iran nuke deals are all over the place and could come at any moment. This is Todd Colvin coming to you from the floor of the CME Group.